Welcome to Sand Compounding. We in the previous session learned about return on equity and what is the importance of return on equity in analyzing and in the terms of valuation of a firm. When it comes to investing, a much better ratio to calculate is return on invested capital or return on capital employed. It's very similar to return on equity. The only difference is the return on invested capital considers the debt portion and it negates the influence of leverage that it has on return on equity. Earlier we saw that return on equity has a drawback because the leverage can influence and pump up the ROE to look higher, whereas in return on invested capital it is more including the operational effects. It is at an operational level and it does not really get influenced by the leverage factor. Let's get into the details of what ROIC and return on incremental invested capital, which is another important concept. Let's understand both this in this session. So the return on invested capital or capital employed ratio really overcomes the challenges faced due to the influence of financial leverage distorting the return on equity ratio. So return on equity ratio, the challenges, the influence of leverage, financial leverage, which could distort the value. If the leverage is high, the return on equity could optically look higher. Now, return on capital employed overcomes this challenge. And how do we calculate this? It is equals, the net operating profit after tax divided over net operating assets, where net assets is nothing but the total assets minus spontaneous liabilities. Here, most important factor is there are two ways to calculate it. One, we could just simply divide it over the total average assets, or we could divide it over the net operating assets. The difference is, in the net operating assets, we are removing the advantage the company is gaining by holding the taxes or by holding the payables. Such things in the current liabilities are removed, so that we tend to take the real actual operating assets. Whereas a quick and dirty way to calculate would be just to divide it over average assets, but that can have a problem because the average asset is generally can vary based on the time period we are taking into account. However, return on capital is still a powerful ratio, where even if we calculate, there could be a small difference in these two ways, but it's still a powerful ratio to understand how good the business is and the quality of the management. Companies need to determine the capital allocation when they start the planning every year or years ahead, right? From a planning perspective, it is important to know this ratio across different segments within the business, because the segments which are operating, or the products, say for example, or the service line which is operating at a very high return capital employed, companies needs to deploy more capital towards, channelize it towards these business segments, buying and thereby increasing higher returns for the shareholders. Also, if this is aided or augmented with a strong earnings and sales growth, then even better, it can create really tremendous shareholder wealth. And that's precisely the reason where companies which have high return on invested capital and high sales growth or earnings growth tend to have higher price to earnings multiple, and they tend to demand a premium over the other companies that do not have such characteristics. Let us look at calculation of return on invested capital with an example. So this is the same Walmart balance sheet that we had seen earlier, and here the total this is the income statement on the left side, where it shows the total revenues, the cost and expenses, the total operating income, which was $22.7 billion in 2017, and on the right side is the balance sheet, because you need both these statements for arriving at return on capital employed. Now, total assets for Walmart is around $199 billion. Net operating assets, by removing the spontaneous liabilities, of $63 billion. Here that is calculated. You see that the payables and accrued liabilities, which are really the advantages the company is gaining by not immediately doing the payments, and or it could be accrued taxes, accrued rents. These kind of things are really not the capital long term, and so they are removed from this, and we arrive at $136 billion of net operating assets. And return on invested capital calculated this way by removing or by dividing it over the net operating assets is called the marginal way, and that fetches us a return on invested capital of 12.2%. And when you calculate the same return on average invested capital, which is $199 billion in 2017 and 199 again in 2016. So net average assets, total average assets is $199 billion. If we calculate this way, we get the return on average invested capital is 8.3%. So there is a good difference between the marginal way and the regular average invested capital. But it is an investor's call on which way to take. Return on incremental invested capital. So now next section we will see what the return on incremental invested capital means, and this is a very important concept to understand. This concept was first laid out by Michael Mauboussin in his paper called Multiples. It's available in the internet. It is a must read paper, another great paper by Michael Mauboussin. So this states the core concept in the paper is, in assessing capital allocation, consider incremental returns on capital first and growth second. Growth only creates value if the investments generate a return in excess of the cost of capital. Note that this return need not be immediate, but no company should pursue growth solely for the sake of growth, and the research shows that rapid asset growth is correlated with weak shareholders' returns. So what does it mean? I mean, typically the core message we can take from this is that the growth creates value only if the return on the invested capital is higher than the cost of capital, which is obvious. If it is other way, it can really destroy the wealth. The faster growth can destroy the wealth. How to calculate the ROIC, return on incremental invested capital, is nothing but NOPAT 1, that is net operating profit after taxes this year, current year that you are evaluating, minus the net operating profit after taxes the previous year, divided over the capital employed or the investment done the last year. So in simple means, this will fetch us the return on incremental invested capital. Now this ROIC equals the increase in the net operating profit this year over last year on the incremental investment made. So there's a little different ratio, very much in the lines of return on capital employed. Let's examine an example to make this more tangible. Say company invests $50 in a particular year and sees its NOPAT grow by $10 in the subsequent year. The ROIC would be equals to 20%, which is nothing but we arrived at by $10 over $50. What if the company invested $100 to get the same lift in NOPAT? ROIC would decline to 10%, and that is 10 over 100. So ROIC is a measure of how efficiently the company grows. This paper by Michael Mauboussin is a definite read to understand how to look at value creation, multiples in context to returns and growth. So here this table there is a table which also explains about mapping done between return on incremental invested capital against the PE ratios, and typically the price to earnings seems to be or demand a premium when the return on incremental invested capital is high. So very important concept to understand from the investment standpoint. So that brings us to the end of this session. Hope it was helpful.